So what do you think it actually takes to survive the stock market? I mean, do you need a genius level IQ or maybe insider knowledge?
Right, or a direct line to some Wall Street trading desk.
Exactly. But according to Warren Buffett, who, just happens to be one of the most successful investors in human history, you don't need any of that stuff.
You really don't.
Yeah, you basically just need the right intellectual framework and the emotional discipline to actually stick to it. So welcome to this deep dive. Today, we are opening up the undisputed Bible of value investing, which is Benjamin Graham's The Intelligent Investor.
It really is a classic.
It is. And specifically, we're looking at Graham's original timeless text, but we're pairing it alongside the modern commentary by financial journalist Jason Zweig. And just to be clear right up front, our mission today is not, I repeat, not to give you hot stock tips.
Definitely no hot stock tips today.
Right. We're here to uncover the deep psychological and structural frameworks that separate those who actually build wealth from those who just completely lose their shirts over the long haul.
And, that separation is rarely about who is smarter. It's almost always about who is more disciplined. Graham is just the perfect guide for this because his insights, they weren't cooked up in some academic ivory tower.
No, not at all.
He learned them through absolute brutal financial carnage.
Right, because before we get into the actual strategies, we have to understand the crucible that Graham walked through. I mean, he wasn't just a theorist projecting models onto a whiteboard.
Far from it. We're talking about a man who ended up with a staggering track record. So his investment firm gained at least 14.7% annually from 1936 until he retired in 1956.
Which is just wild.
It completely crushed the broader market, but he
Yeah.
paid a massive tuition and pain to learn those lessons. Like when he was just a kid in 1907, his mother took in boarders just to make ends meet. She borrowed money to trade stocks on margin, and she was completely wiped out in the financial pan.
Oh man, that's rough.
Yeah, and Graham vividly remembered the humiliation of hearing a bank teller ask if his mother's check was even good for $5.
Wow. Just $5.
Yeah. And then later, as a Wall Street professional, he survived a harrowing personal loss of nearly 70% during the Great Crash of 1929 to 1932.
I mean, surviving a 70% drawdown, that fundamentally changes how you look at a stock ticket,
Yeah.
right? It strips away the illusion that the market is inherently rational.
Exactly. Those experiences showed him firsthand that the market is essentially a pendulum. It's forever swinging between unsustainable optimism, which makes stocks dangerously expensive, and unjustified pessimism, which makes them absurdly cheap.
Right.
That's why before we can even talk about how to navigate that pendulum to build wealth, we have to honestly define what game we are actually playing.
Okay, let's unpack this because I really want to look at that 1934 definition a bit. The line between investing and gambling seems incredibly blurry today.
Oh, absolutely.
Especially with like GameFi trading apps right on our phones sending us push notifications with confetti.
Yeah,
But Graham draws a hard, rigid line between the two concepts, doesn't he?
he does, and it's basically the bedrock of his entire philosophy. So in 1934, he wrote this, let me quote it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative.
It sounds a bit formal.
It does, but the mechanical implications are massive. He means you are analyzing a balance sheet, you are looking at cash flows, tangible assets, and liabilities to find intrinsic value.
But wait, isn't putting your money in the stock market inherently a gamble, no matter what you call it? Like, you're putting capital at risk for an uncertain future reward.
That is a really common misconception, but it kind of misses the mechanics of what is actually happening.
While risk always exists, I mean, there is no such thing as a totally risk-free reality.
Obviously.
The nature of the risk is what changes entirely. True investing downplays that gaudy appeal of speculation by relying on established standards of value.
You are buying a fractional ownership piece of a real business that generates real cash. Speculation, on the other hand, relies almost entirely on the hope that someone else will come along and pay even more for that same asset tomorrow.
Right, completely decoupled from its underlying cash-generating power.
Exactly.
So, investing is like being the house at a casino. The underlying mathematical rules and cash flows put the odds squarely in your favor over a long timeline. I mean, you might lose a few hands, but the structure of the game basically guarantees a positive expected value.
That's a great way to put it.
And speculating is pulling the slot machine lever just because it has pretty flashing lights and hoping a bigger fool comes along to buy your spin.
That is a highly accurate way to visualize it. And if we look at Jason Zweig's modern commentary in the text, he points out a structural reality you just have to accept. The financial industry actively wants you to speculate.
Well, yeah, they make money off it.
Right. Brokerages, trading platforms, the exchanges themselves, they make their money off the friction of turnover. Every single time you buy or sell, they take a cut, either through direct commissions or the bid-ask spread.
So they want you constantly pulling that lever.
Exactly. For a speculator, the constant stream of fluctuating stock quotes is like oxygen. But a true investor focuses on the underlying value of the business, not the flickering price on a screen.
Okay, but if the math of investing is as simple as finding a solid business and playing the odds like the house in a casino, why did the smartest mathematicians on Wall Street nearly destroy the global economy in 1998? Like, why do people with stratospheric IQs fail so spectacularly at this?
That is the million-dollar question. And the answer is that intellect is entirely useless without emotional discipline.
Really, entirely useless.
Yes. Graham makes it incredibly clear that being an intelligent investor is a trait of character, not a trait of the brain. And the historical examples in the sources illustrate this perfectly. Take Sir Isaac Newton.
Oh, wow, okay. Going back a bit.
Yeah, literally one of the most intelligent human beings to ever exist, right? The guy invented calculus. So in the spring of 1720, he owned shares in the South Sea Company, which was the hottest stock in England at the time.
Right. The market was in an absolute frenzy over South Sea trade monopolies, if I remember right.
Yes, a total frenzy. And Newton actually sensed the market was getting out of hand. He famously muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people.
That's a great quote.
So he sold. He pocketed a massive 100% profit, totaling 7,000 pounds.
Wait. So he actually saw the madness, beat the market, and got out with a massive gain. Then how on earth did he end up becoming a cautionary tale?
Because the wild enthusiasm of the market kept going without him.
Ah, the FOMO.
Precisely. The crowd was making easy money, the stock price kept soaring, and Newton just couldn't stand the psychological pain of missing out. He got swept back into the hype, jumped back into the market at a much higher price, and lost 20,000 pounds. Yeah, that's more than $3 million in today's money. For the rest of his life, he forbade anyone to even speak the words South Sea in his presence.
Wow. So he completely understood the math, but he couldn't conquer his own FOMO.
Precisely. And we shouldn't think modern finance has outgrown that kind of folly either. Fast forward to 1998 to a hedge fund called Long-Term Capital Management, or LTCM.
Oh, right, the one you mentioned earlier.
Right. This fund was run by a battalion of elite mathematicians, computer scientists, and 2 Nobel Prize-winning economists.
Literally the smartest guys in the room.
These were the smartest people in the history of finance, but they relied purely on models and lacked emotional discipline when the market defied their logic.
So how did guys with Nobel Prizes blow up their own fund? Like, what was the actual mechanism there?
They used something called convergence arbitrage. Basically, they would find tiny price discrepancies between highly correlated bonds, let's say a 30-year treasury bond and a 29.5-year treasury bond. The price spread between them was fractions of a cent, but their models dictated those prices had to eventually converge. Now, to make real money on fractions of a cent, you have to borrow massively.
You need volume.
Huge volume. They leverage themselves around 30 to 1, meaning for every $1 of their own capital, they borrowed $30.
Okay, so it's not just a matter of making a bad bet. It's like driving a Ferrari at 200 miles an hour, inches away from a concrete wall. You got to be the best driver in the world. You might have the most perfect aerodynamic models, but you've left yourself absolutely zero room for a random gust of wind.
Exactly. And in the markets, the wind always blows eventually.
Always.
When Russia defaulted on its debt in 1998, global markets panicked. The bond prices didn't converge like the models predicted. They violently diverged.
Oh, no.
Yeah. And because LTCM was leveraged 30 to 1, that divergence worked in reverse. It amplified their losses exponentially. They lost more than $2 billion in a matter of weeks.
$1 billion.
Yes. And their collapse was so heavily entangled with major banks that it nearly capped the entire global financial system.
Wow. And when you hit that concrete wall, the math of loss is truly terrifying. This is something Zweig emphasizes that I think just completely breaks people's brains.
Oh, the asymmetry of loss.
Yeah. Like, if you lose 95% of your money in a market crash, you don't just need a 95% gain to recover, which is what everyone instinctively thinks.
No, you don't. The math is brutal. Let's break it down. If you start with $100 and lose 95%, you were down to $5.
Right.
To get from $5 back to your original $100, you need to gain $95.
Which doesn't sound too bad until you look at the percentage.
Right, because a $95 gain on a $5 base is a 1,900% return.
That's insane.
You need a 1,900% gain just to get back to the starting line?
That is mathematically devastating. So wait, is Graham essentially telling us we have to become emotionless robots to succeed?
Well, if we connect this to the bigger picture, Graham doesn't want you to be a robot. He wants you to build your character. The secret to financial success is inside yourself. It's about building the courage to ignore other people's mood swings.
Which is exactly why he constantly emphasizes avoiding structural losses over the pursuit of extraordinary gains. If you fall that deep into a hole through reckless speculation, it is virtually impossible to climb out during a normal human lifespan.
Exactly.
So if brilliant people fail because they follow the herd, and the math of losing is that deeply punishing, it seems like that human urge to jump on the bandwagon flares up worse when an obvious new industry promises to change the world.
Yes. Graham calls this the sure thing illusion, and it's a vital lesson because the logic seems so sound on the surface. You know, people see a technological revolution that is guaranteed to grow, and they just assume the stocks in that industry are guaranteed to make them rich.
Right.
But Graham completely dismantles the assumption that obvious physical growth translates to obvious financial profit.
He uses the airline industry as his primary historical example for this, right? Like, think about the mid-20th century. Air travel radically changed human civilization. It was the absolute, undeniable future.
Unquestionably.
And revenues did explode, expanding at a pace even greater than the computer industry at times. But as an investment, it was a total disaster.
It's a complete disaster.
Yeah.
Because the mechanism of market pricing fundamentally punishes obvious trends. By the time everyone realizes an industry is the future, that foresight has absolutely zero edge. The expectation of massive, infinite growth is already baked into the current stock price.
So you were paying for a best-case scenario that hasn't even happened yet.
Exactly. If you pay a price that already assumes 20 years of perfect hypergrowth, any slight bump in the road, like a recession, a regulatory change, a price war, will cause the stock to collapse.
Because it was priced for perfection.
Right. With the airlines, there was massive overexpansion of capacity and constantly shifting technological problems. In the year 1970 alone, despite hitting a record high in passenger traffic, the airlines sustained a collective loss of some $200 million for their shareholders.
Wow. And that dynamic didn't stop with airplanes. Zweig updates this perfectly with the dot-com bubble of the late 90s. The hype around the internet was so blinding that day trading basically became a national pastime.
Oh, yeah.
The text notes that traders were acting like grasshoppers whizzing around in an August hayfield. It was just pure, unadulterated mania.
And the data Zweig provides on the mechanics of that mania is breathtaking. I mean, the turnover rates were astronomical. Take Puma Technology shares. They were changing hands every 5.7 days on average.
That's crazy.
People couldn't even hold on to a stock for 100 hours before flipping it.
My favorite, or actually maybe most horrifying example from the sources is what happened to a sleepy building maintenance company called Tenco Services.
Oh, the ticker symbol mix-up.
Yes. Its ticker symbol was TMCO. Thousands of traders bought it, tripling its price in minutes on record volume. And why? Because they confused the ticker with TMCS, which was Ticketmaster Online.
That is just the ultimate proof of Graham's thesis right there. A completely irrational mistake born entirely of speed, greed, and a total detachment from the underlying business reality.
Right. It's like buying a lottery ticket based purely on how much you like the font. They weren't buying a company, they were just betting on letters on the screen.
Exactly.
But push back for a second. Didn't the internet actually change the world? Why is it wrong to invest heavily in the obvious future?
It goes back to Graham's crucial distinction. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. By the time everyone realizes an industry is the future, the price is bid up so high that all future returns are basically destroyed.
Okay, so if we know the psychological traps of FOMO, we understand the danger of pricing in the obvious future, and we are terrified by the asymmetric math of catastrophic loss. Here's where it gets really interesting. How do we actually apply this practically? How do we build a framework to survive?
Graham says it comes down to picking your lane and actively isolating your urge to gamble. He divides investors into two distinct types, and the very first thing you must do is choose exactly which one you are.
Okay.
The first is the defensive or passive investor.
What does that actually look like in practice? Are they just like hiding cash under a mattress?
No, no. The defensive investor isn't just timid. It's someone who actively recognizes they don't have the time, the temperament, or the expertise to analyze financial statements for 40 hours a week.
Which is most of us.
Right. Their chief goal is avoiding serious mistakes and losses, and their secondary aim is freedom from effort and annoyance. In practice, this means relying on broad diversification, buying high-grade bonds, and consistently dollar-cost averaging into low-cost index funds.
They want to capture the market's overall economic growth while mathematically insulating themselves from individual company failures.
Exactly. They are structurally removing their own decision-making from the process so they can't panic and sell.
Got it. And the second type?
The second type is the enterprising or active investor. This is the active path, and Graham warns it is grueling.
I can imagine.
It requires immense time, care, and analytical skill. An enterprising investor is actively searching for mispriced securities. They are reading balance sheets, looking for companies trading for less than their net working capital. Basically, companies priced by the market as if they are dead, but they still have a strong cash pulse.
So it requires going against the grain, buying what is highly unpopular, and doing the rigorous math to prove the market's pessimism wrong.
Yes, exactly. But whether you choose the defensive path or the enterprising path, both types have to rely on what Graham considers the central concept of all investing: the margin of safety.
Ah, the margin of safety. Let's talk about that.
Yes. The margin of safety is the mathematical buffer you build into your purchase price to protect against your own errors or, unforeseen economic disasters. Basically, never overpaying, no matter how exciting it seems, to minimize the odds of error.
How does that work mechanically?
Well, you calculate a company's intrinsic value based on its tangible assets and reliable cash flows. Let's say you determine a business is fundamentally worth $100 a share.
Okay.
You don't pay $100. You wait until the market panics or loses interest and offers it to you for $60.
Right, so that $40 gap is your margin of safety. If your growth calculations were a little too optimistic, or if a global recession suddenly hits, that $40 buffer absorbs the shock. It protects your principal from being permanently impaired.
Precisely. You are demanding a discount to reality. But Graham knows human nature.
We're not perfect.
Far from it. He knows that perfectly calculating intrinsic value and reading a book isn't going to magically cure our deeply ingrained human desire for a quick thrill. We are hardwired for dopamine. So he introduces a highly pragmatic compromise that Zweig calls the mad money rule.
I love this rule because it acknowledges that we aren't emotionless robots. Graham admits that speculation is deeply human. It's fascinating, and it can even be fun if you happen to be ahead of the game.
It definitely can be.
So if you absolutely must scratch that itch, he advises putting a small, strictly limited portion of your capital, maybe 10% or less, into a completely separate fund. And his cardinal rule is, never mingle your investment money with your speculative money.
Never. Not in your portfolio and not in your mind. You have to wall it off completely.
It's exactly like going to Las Vegas. If you want to gamble, you put $100 cash in your pocket and you intentionally leave your credit cards in the hotel room safe.
That's a perfect analogy.
Right. You walk down to the casino floor, you play the slots, and when the $100 is gone, you're done. You've isolated the risk. You don't mortgage your house to keep playing.
Exactly.
But what happens if a defensive investor reads a few financial articles, gets a little overconfident in a bull market, and decides to try just a little bit of enterprising investing on the side with their main retirement portfolio?
Oh, Graham is utterly ruthless about this. He calls that the most unintelligent thing you can do. Speculating when you think you are investing. You cannot be half enterprising.
It's all or nothing.
Yes. If you don't have the immense time and accounting skill required to analyze businesses deeply, but you start picking individual stocks because you saw a friend make a quick buck, you will simply become a speculator without realizing it. You have to know your own limitations and stick strictly to your chosen strategy.
Otherwise, you're right back in the trap.
Exactly. The moment you start drifting from your chosen defensive strategy, you are stepping right back into the genius trap that ruined Isaac Newton.
So what does this all mean for us? Let's recap the journey we've taken to these sources. We started by drawing that rigid, non-negotiable line between investing, which relies on intrinsic value and mathematical margins to protect principal, and gambling, which relies purely on the hope of a rising price.
Right, and we saw through the tragic historical example of Newton and the terrifying leverage of long-term capital management that brilliant brains just cannot save undisciplined emotions. You have to build the character to withstand the madness of the crowd.
We learned to plug our ears to the siren song of obvious growth industries because paying a premium for a perfect future basically guarantees a terrible present. We saw that market expectations fundamentally destroy future returns.
Yes, I absolutely do.
And finally, we saw the mechanics of creating strict boundaries, choosing exactly between the defensive or enterprising path, calculating a real margin of safety, and keeping our mad money locked entirely away from our true wealth.
It all circles back to Buffett's premise at the very start of our discussion. The framework is mechanically simple. The emotional discipline required to not touch the machinery when the market is screaming at you. That is the hard part.
It really is. And that brings me to a final thought I want to leave you with, turning this whole concept on its head. Graham used the margin of safety to physically protect his money from market madness. He demanded a buffer against analytical error and crowd hype. But look at the modern world we live in right now, a world of absolute, relentless information overload.
Oh, it's nonstop.
What if we applied a margin of safety to the content we consume every single day?
Huh. That's an interesting idea.
When you scroll your feed, are you demanding a wide margin of safety on the facts and viral outrages you accept before letting them affect your mood and your real-world decisions? Or are you just day trading your attention, jumping on the latest hype, and acting like a grasshopper in an August hayfield? Something to think about until the next deep dive.